and I'm here with you guys to go over what my interpretations or my views on where I think the market is ultimately going to go this week and how price will actually be delivered this week, more specifically when we're talking about the ES futures. Okay. When I'm saying this week, the markets are actually going to open in about 30 minutes from the time that I'm starting to record this video, well, at 6 p.m. this evening Eastern Time, Sunday night, and then it will close for the week on Friday, October 20th at 5 p.m. Eastern Time. So I'm here to talk to you about my interpretations of what I believe price is going to do and how it's going to do it this week. So let's get right into it. Just to let you know, I am not an expert by any means. I am still highly learning this information. I find it fascinating that if you take the time to actually learn, that you can actually really start to predict price and predict its movements and how it's going to move. And basically see that nothing is really random when it comes to the markets and to price action. So I'm just here sharing with you many of the things that I've learned from my mentor. No, I don't know him personally. I just take the classes like a billion other people have. ICT, Michael. Um, but nonetheless, and I'm just here to share with you my interpretation. So please do not take any of this as financial advice. I am just sharing you my thoughts, my interpretation, and just we look and see if price actually does what we think it's going to do this week. So let's get right into it. The first thing I want to say is that I do have a chart that actually has all my markings on it, but I'm starting off with this naked chart because Michael highly believes that you want to start naked so that you can really see what price is intended to do and not let your markings or basically influence what really is happening on the charts. So that I see. And when I was about to go ahead and show it to you guys, might start with my markings, I see that it's so covered up that it may initially make some of you or a lot of you confused. For me, being relatively new in this space, it doesn't bother me at all. Definitely, I feel like I still need it. But just to start off with showing you, I'm just going to give you the general idea of what I'm seeing here, and then we'll get into the charts, hopefully, and then it should help to make a little bit more sense. So the biggest thing I want to say is the thing that starts, we're starting off at the weekly time frame because that's one of the higher time frames. Whenever you're trying to analyze the markets, we want to start with the higher time frames, such as the weekly chart, because that helps us to determine the bias. What do I mean by the bias? Where exactly price is likely to gravitate towards to for the week. It doesn't necessarily mean that price has to close there, just where price is really planning on going to for the week. How's it planning on moving? So does it plan to move up, which is bullish? Does it plan to move down, which is bearish? Okay. So when the first thing I notice when I go on the weekly chart is there's a huge imbalance slash inefficiencies right here. What do I mean? Price is pretty much going up one direction. In it, we see fair value gap right here. We see a volume imbalance right here. I'm not going to spend too much time going into all of that right now because, once again, I'm not here to teach you what these things are. I'm just here to really show you my interpretation of where I think price is going and give you the introductions as to why I think it's that way. And if you're interested in finding out more about what these actual terms are, the more you watch these videos or you'll start to learn more of them. But what I really recommend is that you go back then to Michael, go back to the source himself, Michael of ICT, your inner circle trader yourself, and go back and learn what some of these terms are, or all of these terms are, so that you can really become more knowledgeable, and begin to do these things for yourself. So anyway, the point is, I see a fair value gap right here. Well, I see a liquidity void right here that was literally just filled these last 3 weeks, which is great because price has been repriced and rebalanced. It went up, but then went down. So now we need to see what direction this price truly plan on going next. But I think the work is not finished, because if we're looking right here, here is a fair value gap, which is basically prices being offered only in one direction. So we need price to go back down to offer the sell side, since it only offered the buy side in one direction. So, and then we also see a liquidity void, where not a liquidity void, I'm sorry, a volume imbalance, where basically price is literally they're basically the candles, the bodies of the candles are not touching. You see here, the bodies of the candles are touching. Here, the bodies of the candles are touching. Here, the bodies are not touching. It's separated by wicks. And so when that does it, it basically did not give a proper amount of chance or time for basically buyers and sellers to do what they need to do. And so that's what we usually call a volume imbalance. And because of that, price is usually going to try to fill up this volume imbalance so that it could continue to do what it needs to do efficiently in the markets. So the point I'm making is, with price only going one direction here, we've got the liquidity void right here, fair value gap right here, volume imbalance imbalance right here, and 1, 2, 3, 4, 5 weeks of just up move. I am more likely and more inclined to believe that price eventually and ultimately is going to go down. All right, to make right a lot of these inefficiencies. So that's just where I'm telling you. Now, does that mean that it has to go down this week? Definitely not. So now we want to get to the charts to find out what exactly is going on this week that may help us, or what the charts is telling us so far that may in fact tell us give us a better idea as to which direction the markets and the ES plans to go this week. So with that said, let me go to the information on my chart. Excuse me. I know it's a bit much. Bear with me. Okay? So I showed you where I believe price is reaching. So I'm going to make this bigger so we can try to go through this together. So the first thing I want to bring to your attention is how if we look right here, let me try to go right here. Let's try to go back to this is what I meant to go to, weekly analysis. All right. If we look right here, this past week, right? This candle right here represents 10-9 through 10-14, okay? So what eventually happened was last week, price basically took out daily BSL, which was right here, all right? Now, what eventually happened is we're going to see daily BSL was right here. I'm going to show you that in a little bit, why that happened. But I mean, where exactly that is. But the point is, price took out daily BSL. Not only that, if we look right here, there was 1, 2, 3, 4 weeks where price literally went down. 5 weeks. 5 weeks in a row where price went down. The first thing I want to bring to your attention was the fact that there were 5 weeks in a row that price went down. Let me show you something. All right. Let me show you something that I find pretty interesting. If you go back to, let's just do maximum week. Okay. We're going to go do maximum week. And then I'm going to go to a blank chart. The blank for real. All right. Chart. I want you to go back with me and see how many times do we see price going down 5 weeks in a row. So start with this past time, right? 9-4, 9-11, 9-18, 9-25, and 10-2. We had 5 weeks of down closed candles, all right? Which means where price closed lower than what it opened that week. 5 weeks in a row. right? Here we got 3 weeks. Nope, no 5, no 5. Even here, when things got really nasty, 4 in a row, 3 in a row, right? 3 in a row, 1, 2, 3, 4 in a row, 2, right? So even from our highs that we just went through, right? No 5 weeks, right? No 5 weeks, no 5 weeks. Here we got 4 in a row, right? This is 2020. So we got 4 weeks in a row. Here was the big 2020 drop. We got 2 weeks in a row and 2 weeks in a row. 2 weeks in a row, right? 4 weeks in a row, right? Here we got 3 weeks in a row, 2 weeks, 1, 2, 3, 4, 5. So we got 5 weeks in a row in 2018, right? 3, 1, 2, 3, 4, 5 weeks in a row in 2018. That's when I believe that was the when they call it the market was having a little tantrum because the Fed was starting to raise interest rates again, and what eventually happened is started to react negatively, so they quickly backtracked on what they did, and before you know it, things went fine. But notice, because we had a period where there was 5, 2, 3, 1, 2, 3, 4, 5 weeks in a row, what happened to price? It went down kind of significantly during that time. So if we do a trend line, price went down about, excuse me, I didn't want to do the trend line from there. Wanted to do the trend line from here, from the time where there was 5 weeks, the close, price went up, but then it went down about 12.9%, as you can see in the chart, okay? Now, let's go 3 weeks, 2 weeks, 2 weeks. Look, 3 weeks, 3 weeks, 3 weeks, 3 weeks, 3 weeks, 4 weeks. What are you guys noticing? Does it happen? 1, 2, nope. 4. 1, 2, 1, 2, 3, 4, 5. Okay, here's 5 weeks, and this is 2009, so the recession. But then what eventually happened? Price went up. So that's one time. I didn't notice that one myself, but that's one time. Look at this. 4. Nope. 3. 3. Here's a week where 1, 2, 3, 4, 5, 6. Price went down 6 weeks in a row. And what do we see? From the low of that 6 week, look where price ultimately, how far price went down. 50.5%. And that was in 2008, excuse me. That was in 2008, which was the Great Recession, right? Let's see, we see another time with 5 weeks in a row. We're not seeing it. We're not seeing it for 3, 3, 3, 1, 2, 3, 4, 5. Boom. Look at what year that is, 2002. That's when we're coming off the heels of the recession. And look, price went down 5 weeks in a row. And because of that, price dropped another 21.82%. Okay? Let's go. Let's see. Here's another. And look at the year, 2001, right? And so this was before the infamous 9/11. But look at this. Price went down 5 weeks in a row. And then price dropped another 23.95%. All right? 4 weeks, 3. So this 98, etc. So do you guys get the hint? What I'm trying to tell you is that first and foremost, the fact that price dropped 5 weeks in a row is statistically significant, I believe, to the markets. What's worse is that, and because of that, that makes me further bearish about price going to drop at least another 6%. But as you can see in the charts, that often it's usually coincides with recessions. It usually coincides with the interest rates being increased, unlike the time where the one time where it went up. It was because of the fact that the Fed quickly backed off of the backed off of increasing the interest rates. I believe that that's not going to be the case this time. So I believe that this is cautionary. A lot of the times they were often in or right before recessions. So because of this, I believe that we're going to drop another 6% to plus. So it could be, we're going back to the 4,000s, or we could drop even further, right, where we saw that the others went anywhere from 12 to 20 something percent drops. Nonetheless, that's further fuel as to why I believe that these imbalances are going to be met, and quite possibly liquidity around here may be taken. Will we go back to October lows located right here in 2022? Who knows? But if we do, I wouldn't be too surprised, because once again, this 5 weeks in a row. Furthermore, I remember looking at it on the week before last, on Friday when the market closed. I remember how aggressively price went up that day. And then what eventually happened, I thought, oh crap, well, I guess it's not going to close. I say, oh good, that's proving once again how everything is algorithmic, and it's going to struggle to go up because it's not going to close down for 5 days. So price went as high as, let's see right here, here it is, 4358.5. It went up as high as 4358.5, which would have made the market close positive for the week, right? It would have made the market close positive for the week, which means that 5 weeks in a row never would have happened. And then we would have not seen a potential problem with price being bullish. But what eventually happened was, at the last moment, then price went down that week. Closed down that day. So it went up, and then it closed down below the open to make it the fifth down close candle. So it closed at 4345.25. And you see the open was at 4349, which is why it's in red. It closed down for the week. And so the point is, you see how much price moved up that week, right? It could have just kept going, or it could have just closed right there. But it purposely decided to close here. So the fact that it purposely decided to close on the 5th week this way, this is what made me more skeptical that price was going to break above. You see this right here? Another bearish fair value gap. And what's interesting, this is a weekly bearish fair value gap. So with this in mind, this is a pretty strong level. Below here are a bunch of quarterlies. I'm not going to get into this now. But below here, where price wicked off of, are a bunch of quarterly fair value gaps. And that's why price went up. But despite that happened, once I saw that price purposely closed down, that made me more skeptical that price was going to break above this fair value gap. And so what eventually happened, what did it do? Price literally went into the fair value gap this past week and closed down significantly. Now, here's another thing I want to bring to your attention, okay? So why am I telling you this? I think the market, this was a strong clue. This 5th week was a strong clue about the market's intention about literally becoming pretty bearish for the nearer term. That's what I believe. That 5th week is. That doesn't mean that every week is going to be bearish. No, that doesn't mean that. That doesn't mean that we won't go up a little bit more or now. But I don't think we're going to start getting new highs. Now I think we're going to get lower lows before price decides to start making its highs. Okay, so why am I telling you this? I want to go back to the charts, okay, for the weekly analysis, right? Sorry. If you look at this, then what happened, like I said, when price went, another big thing, right? So there's a weekly fair value gap here. So you see how price went down only in one direction, no upside was offered, right? So then what eventually happened was, this is what we call the weekly fair value gap. This price right here is where liquidity, which is basically where all of the stop orders or the are basically located, where people are basically placing their stops at. The market is always trying to seek liquidity. You'll tend to find it at what's known the swing points. So where points get higher, lower, you see this, the lowest point before it goes higher, or the highest points before they go lower. This is what we call swing points, and you'll tend to find liquidity resting on those areas. So people usually put their stops there. If they're bullish, they put their stops here because they believe, okay, as price goes up, it shouldn't come back here, which means then I'll be safe. My profits will be safe, or my losses will be minimized here. And then if price does go back here, then basically they're stopped out, which means that they basically get to keep whatever profits they have, or they get to minimize their losses. Same thing here. People will place their stops here at the top if they're bearish, right? And so if they believe price is going down, they're going to put a stop here. And so as price goes down, as long as it doesn't go back here, they should be protected. But eventually the market is out for money, liquidity. And so what is it going to do? It's like a little Pac-Man machine that's gobbling up the people's liquidities. But it does it on a set of rules. And this is the interesting thing. I spent all last year on trading, and I didn't know about half of these rules, or the year before that. I didn't know about half of these rules until recently, after taking Michael's class and like I said, ICT. And once I took it, then I understand more about how price actually delivers. Now I see when price is actually about to start going after liquidities or stops, which direction, which ones it plans to take first, and it helps me to strategize more. So anyway, why am I telling you this? The point is when this liquidity was taken out, as we can see, not from this candle, but this candle right here, that's what we call, it created a shift in market structure, right? So basically price went down. Price took out the high. Not only that, there was a fair value gap that was created right here. There was a fair value gap created in the candle before the market structure was taken out. The only thing I don't like about price action right here is that technically, to make this strong, a fair value gap should have been created after it too. And a fair value gap was not created. Instead, what we see is that price took it out. Price took out made a shift in market structure, but it failed to create any sort of fair value gap after it, only the one before it. And so with that in mind, this is when you would keep your ears and eyes out for a possible chance of reversal. Now, what eventually happened, because this was the 5th week that price went down, like I told you guys, then what eventually happened, something told me 9 times out of 10, I really believe price is going to go down. That's a bearish sign for the market. That doesn't mean that it has to go up, that it will just have to go down, that eventually is going to go down. So when I did the charts, I saw once again the weekly fair value gap that's here. And then I went and I looked for the CE, which is basically the middle of the weekly fair value gap. And that price is, give me a second, the price of the middle of the weekly fair value gap is, give me a second, I have it, but I got so much stuff on here. CE weekly fair value gap is 4438.75, right? Remember that number. All right. Why is that important? The CE basically tells us um, it's half of the weekly fair value gap, right? So I said if that's the case, then price definitely does not want to go above or indefinitely close. Even if it goes above, it definitely don't want to close above that weekly fair value gap. If it does, then that's more indicative that price would be bearish. But if it goes there and comes back down, then 9 times out of 10, price is bearish. Okay, so if it goes above it, it will be bullish. If price goes to it or not even to it and go back down, then that's bearish. I kind of wanted it to get into the CE or as close to it as possible, because usually if it just goes a little bit of the way, price may go down some, but then it's going to quickly come right back to it. So I was happy to see price do this. Now, if I just to piggyback, well, let me just stay on one thing first of all. I'll stay on one thing. I'll stay on the weekly first, and then we'll get into the daily. But there was something else I was watching, and I might as well just tell you. What I was also watching, and we'll see it on the charts when I go to it next, was on the daily chart that there's also a daily fair value gap located inside of the weekly fair value gap. So that's right here. And if you look for it, that price is between 4462.25 to 4399, right? Now, what's interesting about that is that if you find that daily fair value gap, and I'll show you more about it when we get to that, the CE, which means the middle price of that fair value gap, is 4430.62, right? What does that mean? That means that price is actually, that's the middle of the fair value gap, that bearish fair value gap. If we want to see price, or if we believe that price is actually going to stay bearish, we want to see price stay below it or close below that fair value gap. If we see price, that CE, that the CE of that daily fair value gap, if we believe price is going to go bullish, then we want to see price break and stay and close definitely above that CE fair value gap. When price not only did not get to the CE of the weekly fair value gap, which is a few bucks, 4438.75, but literally it went to 44. You see the CE daily fair value gap was 4430.62. Look at what the high of this candle was, 4430.5. So literally price went slightly under, or we could just say it went to the CE of the daily fair value gap. And then what did it do? It dropped back down aggressively. This is a great sign, right? Because why? It shows that in the end, that price did not want to, it had no plans of going up or stay up, that it was very bearish. And then it closed significantly down. Now, pay attention to this. There's a few other things about this that's pretty interesting. So right here, price closed down, and it closed down and out below the weekly fair value gap. It closed down and below the daily fair value gap. You see, it wicked down and closed down. All right, even retail patterns. Michael hates retail patterns. I understand 100%, but those who know retail logic, you know that this is usually a very bearish sign. Now, why I believe what Michael says, and he has a right to say not to trust not to trust retail patterns, because oftentimes price has a habit of going up regardless. And look what price is doing now. Now the market is open. It's 6:02 now. I saw it when it came, but I didn't want to stop my train of thought while I'm talking to you guys. Look at how price is opening on the YM, which is the Dow futures, and the NQ, which is the NASDAQ futures, and the dollar, right? It opened up aggressively, right, on those. And so the ES is doing the same right here. If you can look, it's the yellow chart is here. I'll move to this one so you can see better. You see, it opened up here and it's up. All right. And so all three of these, another little tidbit, all three of these will tend to move in the same direction. So the indexes will tend to move in the same direction, which is usually the opposite of the dollar. So this is actually moving according to plan. Why? I'm going to show you exactly what I wrote in the plan. All right. If I believe price is bearish, then that means then price will have to do what? Price will have to go up some and go down. Now I'm telling you this, right? It's only going to go up to go ahead and go to some inefficiency, which in this case, this gap is considered an inefficiency. I mean, this wick. Why? Because the market and the algorithms tend to look at wicks almost like gaps, right? Because price can't really hold there, and if price can't really hold there, then it's kind of like an inefficient delivery. A lot of times people can't really get in and out of their positions on these effectively on these wicks, right? So what eventually happens is price usually goes up here. If price is going to be as bearish as I think it's going to be, what I anticipate is that price is not going to go above 1/2 of this wick. And that's kind of like the CE, or the midpoint of the wick. If it stays below that wick, which means it can go above, it can wick above, but it has to close below it. And when I say it has to close below it, we're talking about definitely by the end of the day, it has to close on it. And we're not talking about today, Sunday. We're talking about, Monday. Sunday, Monday is like one technically market day. Price has to close below it. But I also like to say, well, I wouldn't want to see it close anytime above it on the hourly charts too. I'm not sure 100% if that's really set in stone or not, just something I like to see. But definitely by the end of the day, we don't want to see it close above it. So what is that price? Let me go back to the chart where I have on my chart. I'm going to tell you what that price is. If price is really bearish, plans on being bearish for this week, we don't want to see price go above the CE weekly wick, which is right here, 4391. Okay? Now, there's a lot more I got to tell you guys. Look at this. If price is really bearish, we really, it'll be great if price doesn't even go 1/4 of the weekly wick, which is right here, 4371. So the CE wick is 439 wick, weekly wick is 4391. That's, we want to see price stay and close below it. It can technically wick above it, but it definitely has to close below it at 4391. But if it basically have trouble getting above and closing above even the 4371, which is the 1/4 weekly wick, 4371.25, then that's a really great sign that price is really bearish. So these are the things we want to watch this week when price goes up. Okay? All right? So just giving you that heads up. Now, the next thing we want to see is look at where price is stopping right now. This is so beautiful. This is why I love the markets. Look at where price is stopping right now. All right? Look at this. I'm going to try to make this. I can't make it any bigger. Frick. All right? So anyway, let me go to the daily so maybe you can get a better picture. You see, this is the daily chart, right? And here is the wick. Basically, if you look right here, we're technically in a daily fair value gap. So remember what I showed you guys. You see right here, between here and here, price goes up, price goes up, price goes up. When price goes down, the wick does not touch this wick, which means then price didn't offer a fair, price only went up offering the buy side, but it didn't offer a fair chance for sell side. So that's once again what we call a fair value gap. And this gap was created on the daily time frame, right? The daily time frame is one of the strongest time frames because this is where price and the algorithms tend to move its day-to-day, base its day-to-day movements off of on the daily time frame. The weekly time frame you use for the bias, meaning is the price likely to go up or down for the week, but the daily time frame helps you to better determine the draw on liquidity, or which inefficiency, meaning where exactly is price about to go to, which liquidity, whether it's the buy side, those stops located bullishly, or whether it's the sell side, those stops located bearishly, that is going to attack, or whether it's going to attack some sort of inefficiency, some volume imbalance, fair value gap, etc. That's bullish or bearish. Okay, so anyway, why am I telling you this? Look at this. So right here is a fair value gap, and so it's a daily fair value gap. The fair value gaps, once again, you want to break it up according to its center. Find out where the center is. That's what you call the CE, right? Michael says it stands for consequent encroachment. So anyway, what happens is that you want to look to see if how does price move and react according to that CE. If price stays under, it's usually telling you it's bearish. If it goes above, it's bullish. When I first started getting all happy and excited, price was actually staying under it was wicking and staying under the CE, the consequent encroachment of the fair value gap. So if I were to go to a minute chart, let me see, I can show you better. See, when I started getting all happy and Joe, you see price went up, it wicked up, and then it went down, right? But now price is firmly going up. So why was I saying that? Oh no, so here, the CE, here it is. The CE of the daily fair value gap. So it went here, it wicked, here it wicked, here it wicked, here it broke, here it went down, it was below, but then it broke above, right? So nonetheless, this doesn't mean diddly squat, because remember I told you that it can wick above, but it can't close, and you don't want to focus on a 1 minute time frame. This is a daily fair value gap, so we're talking about by the end of the day, but you can also use it, like I said, definitely by the end of the day to determine if price is going to be bearish or bullish. You want to see how it closed relative to this wick. But I also like to look on the hour, just go a time frame down from where we currently are. So for as a day trader, the hourly time frame is the next best time frame for me. So being in and out of the positions for the day, and so I like to see how price will close on the hour. So that doesn't mean necessarily abandon it by the hour, but that's what I like to see. But definitely by the end of the day, price better not be above there. If I find that price, on any of the hourly time frames is not closing above 4362.37, which is the CE of the daily fair value gap, then that signifies to me price is bearish. Will signify to me if price is bearish. If it does signify, then that means price still has more room to go up. Does that mean price is still bullish for the week? Not necessarily, and I will show you why. Okay, so you see, this is what I was saying. I was happy about this because it was indicating to me that price was bearish, but now it's going above. Still doesn't mean all is lost. It's only 11 minutes into the market. We still got plenty of time to see how price really intends on closing. Another thing I want to just stress to you, see how the market, if I were to go to the 5 minute chart, you see what happened? The 5 minute charts, the market gapped up, right? So the indexes gapped up. Here's a gap. Here's a gap, right? The dollar gap down. What did I tell you guys? That the market has it I would say hate inefficiencies. It can't run on inefficiencies. It has to be a fair deliverer of price. I know people think markets are gambling and that they're just out to take your money. It's true that they're out to take your money, but they run on some real rules that have to be fair. And so with this in mind, what it's showing you is that because this right here is an inefficient delivery of price eventually has to close this gap. All right. price eventually has to close this gap. And so with that in mind, what we can look forward to happening eventually is this gap being filled. Does that mean right away? No, you'd be surprised how far markets and price can go up before it eventually fills the gap. So this is when you would want to let price run up and do its thing, and then you want to look for some sort of clue and bearish setup. Bearish setup, that means now price is ready to come back down. Once you see that price is ready to go back down, then that lets you know, hey, I can take a position to right here. But once again, it depends on how far up it goes. If it goes really far up, then there may be another price where you target where you may better be off. You may be better off exiting out of and eventually waiting for price to come here. Okay, so now let's go back to what I was saying. So 3 years, 3 weeks. Where's price going to for the week? So I told you price is going bearish, right? What I wanted to say is here is a daily fair value gap. What I would like to personally see is this this gap right here was a daily fair value gap, right? I would like to see price, give me a second. Was it just a daily fair value gap? Give me a second. Yeah, it wasn't just a regular daily fair value gap. So let me change this right now. This was a break of market structure. That's what I thought. All right. So this right here, and let me show you more clearly. This right here was a break of market structure, daily fair value gap. Well, let me explain to you what's a break of market structure. So remember when I told you about the market structure shift? Here's a swing point, right? If you look on it, it's got a low here, high here, low here. That's a swing point. So price went down, went up, swung up, and then swung down. This is a swing point, which means stops are located right here. This is a swing high point. All right. So nonetheless, price even and you know what? Another thing I want to stress to you too. Swing points can also be a singular candle. So when you tend to have a candle like this one, where you see how the body's small but the wick is extremely long, that's what you call it's creating a swing point within that. And so that means that one candle is creating its own swing point. So even if these were higher, right, or higher, one is higher than the other, this would still consider the swing point, because eventually what this is telling you is that in that candle, price had to have been here, had to have gone up, right, price opened up here, had to have gone up, right, all the way up here, and then eventually came back down. That's what that's telling you, right? And to eventually close somewhere down here, have gone down here, close up here, right? So that's what it's telling you. So this candle alone is swinging. And then if I were to go to, let's see, this day is 9/29. I want to show you exactly. If I were to go to an hourly chart, let's see, on 9/29. 9/29, let's go look for that day. $9.29. All right, here's the 29th. You see what shape happened here? So now you can see more clearly the swing point, right? Here you can see more clearly the swing point right here, okay? So, and then here you see there's another swing point located right here. So if you were to go to a lower time frame on 9/29, this 20 days, so let's try 15 minutes, but we need 20 days. 15 minutes. Okay, 30 days, 9/29. Let's go there, 11 a.m. All right, so you see, look at this. It's creating more swing points. A swing point here, right? A swing point here, All right, swing point here, etc. And if you keep going down to the low time frame, you'll find more and more swing points. Okay, so the point that I'm just trying to show you is going back to the, was it the daily? This was definitely a swing point, but no, it was the weekly. Oh no, it was the daily. Going right back here, this was a swing point, and what eventually happened was that there was this high, this candle right here broke that high. So you see price was going down, right? And then what happened? Price started going up. Here, eventually here, price took out liquidity, which means it took out the stops that were located here. So stops were here, price went up, and then price took out liquidity here. All right, let's see if price took out more liquidity somewhere else. Boom. Yep. So you see this? So price took out this liquidity here, right? And then once the candle went here, price took out this liquidity, right? So you see how it's taking out these stops, swing points here, took out one here, took out one here. And then price went into this fair value gap. You see how price went here, price never came down here, so price went into this inefficiency. It went into, hold on, did it go into that inefficiency? Nope, it didn't. Price only went into this inefficiency. Price only went into this inefficiency, which means 9 times out of 10, price may go into this one. All right? But nonetheless, price went here, and then it closed above the mean threshold if you were to make a whole fair value gap here. Let me show you. If you were to make a whole fair value gap here, edit, and I'm just gonna make it go extend here. Then you see price basically went into, and about halfway, if I were to eye this, the wick, you see that? So it's about 44.75. So the wick went, the wick went slightly below the CE, which means the midpoint of that gap. But you see what price did? It closed by the end of the day above that gap, and that was letting us know that price was ready to go bullish. You see that? But the point is, price is still not officially delivered in this wick. So that's further fuel for the fire for what I'm saying, why I believe price is going to go down again, because it still have the whole lower portion of the gap that eventually it has to officially fill price to. And then on the weekly chart, we saw that there were more areas going back down to the low 4100s, even 4000s, possibly below that. So anyway, why am I telling you this? So when price made this break of market, the point is price broke this high right here, right? And because it broke this high, then what eventually happened, it formed a market structure shift, or what I call the break of market structure, or Michael called it that, whatever. And then what happens is that, what eventually happens is that the next candle came and now formed a fair value gap. This is what I told you is missing with the current price structure that I was talking about. Price formed a fair value gap. So we see that's why the daily fair value gap is formed here. Because it formed a fair value gap, that candle, that same candle, whenever I tend to see that same candle that broke the swing higher, the swing low, also is the same candle where a fair value gap is formed. That's what I tend to call a break of market structure fair value gap. And why is that important? Whenever I tend to see these, and I've back tested countless amounts of these, whenever I tend to see these, they tend to be exceptionally strong. What I mean by exceptionally strong, meaning that price, usually when they retrace back into them, usually they'll move aggressively in the direction that you anticipated price to move into. So in this case, this was supposed to be a bullish break of market structure. See right here, first time price went into it. You see what happened? Price wicked up. right? And then, so price went into it. It opened here, right? Price opened here, went up here. It went down into the fair value gap, and then it wicked up significantly, right? So that was pretty powerful. Then what eventually happened the next day, price opened here, and then what did it do again? It wicked up. So this is what I'm saying, that movement is very powerful. But you see what eventually happened is that this past week, price broke down below it. And because price broke down below it, then what eventually happened, that became a bearish sign. Now, when that happens, now what we tend to look at this to be is what's known as an IFVG, which means an inverted fair value gap. What's an inverted fair value gap? When the fair value gap is acting opposite of the way that it's expected to act. So in this case, this was a bullish fair value gap because price went up only on offering price on the buy side, right? So it was a bullish fair value gap. And so what happens is we just expect price to retrace into the gap and then go up bullishly, right? That's how fair value gaps. If this was a bearish fair value gap, that means then we price would have been here, price would have gone into it, and then we expect it to do what? Make price bearish. So price retraces up into it and then breaks down and go back bearish. So that's how bearish fair value gaps and bullish fair value gaps work. So at first, price did its job. It went into it, wicked up, went into it, retraced. So price went in, had it, retraced finally into it, and then it wicked up, which means right here, anywhere here would be a great opportunity to buy. All right. Notice how it wicked out a little bit. So you want to make sure that you have stops because you never know exactly how far price may go down to, and you want to make sure that it's something that you're comfortable with actually losing in the event you have to you do have to pull out. And you want to also make sure that you understand that there's no such thing as a sure thing with anything in price. These are only speaking in probabilities, what's more than likely expected to happen. That does not mean certainly will happen. It just means more than likely. Okay, so even 9 times out of 10, these things may happen. 8 times out of 10, these things may happen. That doesn't mean it's always going to happen. And hey, that one time it doesn't happen without the proper risk management in place, which means without your proper stops and you actually adhering to your stops, that can be literally the difference between a live account, meaning not a live account, between your account being profitable versus you blowing your account. So I'm making sure to tell you that too. But nonetheless, the point is price broke below this. And not only this, if you look for the day, the wick, right? Half of this wick is about right here. Price broke below that wick. It broke below it and closed below it. That's bearish. Price also broke back through this very strong break of market structure. That's fine because it already did its job of going up, holding price up. But eventually, what did it do? Price broke below. So what I like to see happen today, meaning between today and tomorrow, before the market closes, I want to see how price closed in relation to this fair value gap. Because this is now, because price had closed below it, what I anticipate will happen is that price may go up like it's going up right now, but then I don't expect price, to be honest, to go higher than this 1/4 weekly wick, which is at 4371.25, or at the very most, right here, 1/4 of the daily wick, which is at 4387.5. All right. Why do I say that? Because I expect that this is now going to act as an inverted fair value gap. If it's an inverted fair value gap, that means even if price wicks up, then it's going to close down. Why I think more than likely the 1/4 weekly wick is more realistic, because that would be a long behind wick to go all the way up here and then wick all the way back down. All right. Especially below the CE, especially below the CE. That's what I want to see it. I want to see it close below the CE, which is at 4362.5. Okay. To show the bearishness. But even if it wicks anywhere here, that'll be okay. I mean, closes anywhere here, that'll be okay. But I really want to see it stay below, close below the CE 4362.5. What I also wouldn't mind happening is that if price goes up here, it wicks off of the bottom of the weekly fair value gap. But once again, I wanted to hurry up and still close below this daily fair value gap, or in the daily fair value gap, and then the next day it can close below. Why do I say that? Because the bottom line is I want to see that this truly is acting like an inversion fair value gap. If price closes anywhere tomorrow above this gap, then that's going to lead me to believe that price is temporarily more bullish for the week, not bearish. So if the bearish thesis is to go ring true, I need to see price not close anywhere above this daily fair value gap, which is at 4366.25. And to be truly bearish, I want to see it close below the 4362.25, which is the CE of that weekly fair value gap. Okay? So that's my thought. And that would be perfect, because usually what we tend to see in price, you see how price was above the weekly fair value gap, and then it went down, and then it went back up, and it went to the CE, and then it goes back down. And then when that happens, I tend to like to see price go to just the CE. I mean, just to go to the fair value gap, but not go in. The point is, what you want to see is that price is getting lower and lower and lower in terms of its entry into the fair value gap, until it no longer goes into the fair value gap, signifying it's ready to go down. So if price were to go or wick to the fair value gap, the bottom of it, which is at 4385.5, and then, like I said, aggressively go back down to close below the CE of the daily breaker market structure fair value gap, that would be extremely powerful in suggesting that price really is going bearish for the week, which I believe it's going to do. Now, I didn't quite finish going over why I believe also is going bearish. I believe why I told you is going bearish, period. But I believe I told you why for the week. Look, once again, the biggest thing is look at how price, once again, had the weekly fair value gap. It went to the CE, which is the center of the weekly and the daily fair value gap, and then wick down aggressively. Not only that, if you look right here, here's something that's called an order block. More specifically, it's a bullish order block. I am not going to pretend to be able to define the order block to you really well, really well. But I've studied them enough to know how to work them and how they move, but I don't know if I know them really well enough to define it to you in a way that makes sense. So once again, I'm going to tell you, go back to Michael. You want to go back to the source for these things. What I can tell you is that this is a bullish order block. And what I mean by study them, I didn't just take a book and listen to Michael speak and just take some notes on YouTube videos and whatever else. I've actually gone through my charts, back tested them, see how they work, what price does, how they move from when they hit them, etc., 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 to really come to understand how they work. And Michael uses a great analogy that when you think of order blocks, that they tend to think of them like traffic lights. They tend to conduct the traffic, and they tell you to which direction you can actually go in. So with this in mind, an order block usually helps you to signal if price is going bearish or bullish based on how price reacts off of them. All right. So this right here is what's known as a bullish order block. Why is it a bullish order block? So right here, oh, excuse me, a bearish order block. Am I right or wrong? I don't know. It's an order block. Tag on it. Okay, let me tell you why it's an order block. So anyway, right here, right? So price was here. Price was going up bullish, then it went down, right? But then here, price went up, right? I think this is a bearish order block. My bad. All right. I think this is a bearish order block. So price went above it. So price went above it. But then you see what happens? Price closed below it. When price closed below it, that changed this into a bearish order block. My bad. So let me go ahead and change that. Weekly bearish order block. Let me change that. Bearish order block. Whenever I put a minus sign in front of anything, that means bearish. Okay. For me, if I put a plus, that means bullish. So this is a weekly bearish order block. Why? Because here, what it is, this is some kind of resistance, right? So you see how the price is topping out here. It's having trouble closing above here. Here, right? And then what eventually happened? Price closed below the weekly wick, right? Price closed below the candle that was running up into the resistance, which is this full body. You want a full body. You don't want something like this. You want something that's a full body. And the reason why you want if we're talking about price going bearish, you want the candle that's bullish running up into resistance. If price is going bullish, you want the candle, the down close candle, so the bearish candle, full body candle that's running into the support level. Got it? So anyway, this candle runs up into, this candle is the candle that runs up into the resistance area. And then and it's a full body candle. And then what happened? This candle breaks below this candle. Once it breaks below this candle, immediately, it doesn't even have to close, but once it breaks below, it immediately turns this into a bearish order block. And what does that mean? You see how price is moving bearishly in one direction, but then this price right here, this candle right here, price is the opposite direction. This candle right here, price is the opposite direction, and it's bear, opposite direction. And then bear. That's what Michael calls a change in state of delivery. So price went from being bearish right here to bullish right here to being bearish right here. And what's the change? At first, price was being bullish, right? And then it went bearish. And then here, how do we see that it went bearish? Well, that's the point. It's actually the bearish order blocks were created here and here. So that's what eventually changed it. And then we see here again, price goes up, boom. So this is a bearish order block. Price is bearish, bullish, bearish. And because technically it's going down more, that's what makes it a bearish order block. Why am I telling you this? Whenever price wicks off of an order block, what you expect price to do off of order blocks, you expect an immediate reaction. It usually has to be immediate, and it usually has to be a violent reaction. All right? And so what happens is if the price wicks off of the bottom, off the body, if it's bearish, it has to wick off the bottom body. If it's bullish, it has to wick off the top body. If it wicks aggressively and violently off of that body, that's usually indicative that price intends to go that direction, which means in this case, it tends to continue to go aggressively bearish. Now, keep in mind, like I said, I back tested these Lord knows how many times. Just because it did that this week, that does not mean that price will not go up. In fact, what order blocks tend to do is that price will usually tend to run back up into it, right? Sometimes it will, sometimes it won't, but usually I tend to see that they do. But if not, price will still run in the direction of the order block, towards the direction of the order block, to give market participants a better chance of entry. So the moment that in this case, what I'm saying is that price went up into the order block. You see, the bottom body was at 4418, right? Price wicked up all the way up into 4430.5, which was that CE daily fair value gap. And then it went all the way down and closed at 4351.5, which is well below the 4418, right? So now what happens, what we expect is price will go up because it has to give now smart money that opportunity to recognize, oh dang, price done wicked off of the bearish order block, which means price intends to go down. But if you're smart money, do you want to buy price when price is going down? No. That's something that not too smart money do. What I used to do, all right? And what I'm still working on making sure I don't do. All right, I'm still learning, so sometimes I'm guilty, but nonetheless. So what you want to make sure that you do is buy when price is actually going up. If you know you have to trust that you see the clues of the market. Price made wicked off of the daily fair value gap, the CE of the daily fair value gap. It didn't even approach the CE, the center of the weekly fair value gap, which is at 4438 and change, right? 0.75. And then it wicked aggressively off the weekly bottom order block. So technically, both of this is considered an order block, a bearish order block, but you want to get the top one if you're bearish and the bottom one if you're bullish. So it wicked off the top one at 4418 and then aggressively and violently went down. Classic order block signature, which means now if you take all of these clues, what is that suggesting to you that price wants to do on the weekly chart, because we are in the weekly time frame? That is suggesting to us that price intends to go down. But you have to recognize smart money, that price will first go up to give smart money that opportunity to buy cheaper, right? To buy cheap. You want to get right, and or people who are selling, those are the ones who want to sell if they haven't gotten rid of their positions. You want to sell at the more expensive parts, and then you want to buy cheap, right? That's what it is. And so what happens, you're going to buy your shorts cheap because price is going up. And so with that in mind, the people who are long, they'll be able to sell at a lot of money because price is up. You understand? And so what eventually happens is price will go up, classic order block signature. But if we still believe that price is bearish for the week, I need to see that price is not violating, going back here on the week. So I hope you guys understand this, why I'm so bearish for the week, that price is not violating that CE of the weekly wick. Of the CE of the daily fair value gap. I want to see it price close below that, because I want to see that that's actually acting as an inversion fair value gap. What I also want to see is that if price is wicking, that price doesn't wick higher than the 1/4 weekly wick, or at the very, very most, the CE of the weekly CE of the weekly wick, or CE, let's say CE of the weekly wick. Why did I say that? I want to say the CE of the weekly wick. The chart is also saying CE of the daily wick, quite possibly, but no, I'm going to say the CE of the weekly wick at 4391. If it goes to 4344.94, sure, but then either sell or re-enter or whatever. But yeah, technically it can go there. But I don't want to see it cross that. Whatever happens with price, it can wick, but then it's going to have to close aggressively higher. So to me, it makes the most sense that it wicks somewhere around here. I really don't expect price to go past the 4371 if it wants to wick, which is 1/4 of the weekly wick. If it does that, then that shows that price is extremely bearish, and then it's going to go down. The higher it goes, then it has more probability of showing a little bit more bullishness or volatility. But again, I need to still see it aggressively come back down and go down. And if it does that, it basically keeps everything intact in terms of price and how it plans to react. That it plans to be bearish, because it wicked off the weekly order block, which means price more than likely plans to go down, significantly down this week, possibly close down for the week, because it wicked off the bottom of the weekly order block. It went into the the CE, the middle of the bearish fair value gap, and then wicked aggressively down. It closed below a break of market structure, daily fair value gap, which is extremely, extremely difficult for price to usually violate that easily, and it did. And so when it does, it may tend to act as an inversion fair value gap, which means then it may act to keep price down instead of up like it was initially supposed to. And so all of these are reasons. Now, one last thing I want to draw your attention to is fibs. All right? Fibs. Fibs tell a powerful story, and everybody I'm seeing uses them very differently. Michael uses them very differently, and I'm still trying to learn how he uses them. All right? But from what I see, all right, I'm just speaking for what I tend to see. If you draw a fib from the very top high, and why did I choose this top? This is the last swing high point, right? Which was at 4566, which was formed on the week of 9/11. And then the most recent swing low, which was formed at 10/2, the week of 10/2, which was at 4235. If you tend to draw a fib, a Nachi, between that swing high and that swing low point, and as you can see, this was a period where there were the 4 weeks in the of the 5 down close weeks were represented in this fib. What you tend to see is this is basically the high and the low point that price traveled to during this period of time. When you draw a fib here, basically what you want to do is then find what that 50% level is, because price traveled completely in one direction this way. So this is what we were talking about, that displacement that happened, right? So price broke the low right here. There was a fair value gap that was created here. Unfortunately, I have not yet seen a fair value gap created right here, which is the 1 weak area in my theory right now. So if price were to go up, then I can't be too surprised, though I highly doubt it. But it's because price didn't create a fair value gap below it. But one thing I will say is that nonetheless, a market structure shift had occurred here, and then there was a fair value gap that was formed in front of it. And what eventually happened was that when you draw the 50% fib line here from the swing high to the swing low, what you tend to see is that the 50% line was located exactly at, give me a second, 4,475 cents, right? So why is that significant? That's what that line right there, the 50% line between the high and the low of any swing point, is what we call equilibrium. Why is that significant? Basically, the way the algorithms work is that, remember, keeping in mind that price always likes to be, has to be, I'm quite sure it's based on federal regulation or something of that nature or whatever, but price always has to be fair. It has to be fairly and efficiently delivered. Then what happens is that if price went down completely in one direction, then it has to give a fair opportunity for participants to be able to come in and enter the market, right? And it has to do it in a way that's going to be able to give them a chance to enter at a discount, which means at a cheap enough price where they can become profitable from, right? So what eventually happens is, when it does that, what you'll see whenever price tends to move aggressively in one direction, so from swing point to swing point, right? And it's usually shown a sign of displacement or breaking of market structure. Then what you want to see is when you draw the fib, you want to basically find out where that 50% level is. Wherever that 50% level is, you want to find out what's the closest swing point that is created above that 50% level if you're going bearish, and below that 50% level if you're going bullish. All right, you heard me right. I didn't make a mistake. You want to find the closest swing point that is taken above that 50% level if it's bearish, and below the swing point that's located, swing low that's located below that 50% level if it's bullish. Why? Because what's going to happen is that price often is going to go ahead and go back into that discount level, which means, hey, price went down, and anybody who bought while price was going down here, they're making out nicely, right? But once you start getting past the 50% level, it's no longer a good time to buy. It's now too risky to buy because here you're at the lower half, so you're basically trying to short the market when price is already all the way at the bottom, right? So you never want to short below equilibrium, and you never want to go long above equilibrium. You want to short above equilibrium. You want to go long below equilibrium. Got that? And so what happens is when price only went one way, only these people were cool. Everybody else here were not cool, but price just kept going. So now it has to go ahead and make a chance to deliver the market efficiently, where people can actually get in and fairly profit out with the market, right? So eventually when you see that structure happen, that break of market structure happen, usually with the fair value gap created after, right? Then what you want to see is you draw your fib, and then you want to go ahead and find out where that 50% mark is, because that means that anywhere above that 50% mark is where you want to start placing your shorts if you're going short. If you're going long, you want to once again place your longs below that 50% equilibrium if you're going long. But how do you know where price more than likely will stop? It will tend to stop at the first liquidity point, so swing point that's taken out above or below that 50% mark. So again, it will be above if you're going short, or if price is going short. Not if you're going short, if price, you want to be on the right side of price. So if price is going short, or it's going to be below if price is going long. So why am I saying this? You see where it said daily BSL taken, right? So on the chart, on the daily chart, I had the BSL located right there. So I can just go to it now. That was on the week of 9/25. So let's go to the 1 year, 1 day. Let's go find where that is. Here it is. All right. So here's the daily BSL, right? Here's the fib. So all of these days is literally the days that's represented in the weeks, the 4 weeks for the fib, right? So anyway, here's the daily BSL. Remember, I told you this is a swing point because even though the candle to the left of it is higher than it, if you're looking at the candle, it has a very small body with a high wick. And so that's letting you know that this is a singular swing point. If you were to go down to the lower time frames, you would more easily see the swing points, which we did earlier. And so this was a daily BSL. And so price took out that, and if you look at it, it was slightly located. It was located slightly below 4399, right? And then the 50% fib was located at 4400.75. So about one handle, or $1 in essence away from each other. So remember, what did price do? Price had to take out that SSL, BSL, that liquidity, buy side liquidity. And then once it took out that buy side liquidity, it basically now put it above the 50%. So it accomplished 2 birds with 1 stone. You see that? So price took out this liquidity and went back into a discount level, right? It went above the 50%. And even better, it went into the fair value gap. And even better, it didn't break the CE of the fair value gap. And even better, it didn't break the CE of the weekly Let me see if it actually didn't break. It didn't break or didn't close above the weekly CE. No, it didn't even break it. It was like here. And let me show you how algorithmic this is. Look at the high of this price. The high of this price is 4430.5. And the CE of the fair value gap was 4430.62. Tell me, that's freaking coincidence? I think not. It touched literally the bottom. If you want to say, well, there is no 6-2 in the chart, so it could technically be 5-0 or 7-5, then yeah, we can say that. But you see what it did? All it did was touch it, didn't break it. And then definitely didn't close above it, right? And then what did price do? Then it turned around and wicked down. So all of this is clues for the smart money. You see all the and thens I'm keep saying? All of this becomes clues for the smart money that price intends to go down. And you see what happened the next day? Price went down. And even better, it wicked off of the body of the daily, the weekly fair value gap and closed down. And even better, closed below the break of market structure. So this is why I'm so adamant that I seriously doubt that this one is going to go past the 1/4 CE. I really don't think so. All right. And that's the 1/4. This is a 1/4 1 hour wick. Excuse me. I mean to say, give me a second. I want to find the right number. No, that's not the right number. Yeah, the 1/4 weekly wick. I don't think it's gonna. I seriously don't think, and that's at 4371.25. I seriously don't think that. But if it were to go, then I would say it wouldn't go definitely past the 1/4 daily wick, which is at 4387.5. Why? Because if it goes up here, but not even gets up there, if it goes to just the bottom of the weekly fair value gap at 4385.5, then that's showing extreme bullishness because price refuses to go back into the fair value gap. And on top of that, it's not going above 1/4 of the previous day wick, or not the previous day of the daily wick. So marked by these two things, that's definitely very bearish. And then, like I said, I would then want to see it wick aggressively down to close below this because I want to see this act as an inverted fair value gap. If it's still acting like a regular break of market structure fair value gap, then that would be the thing to make me question my my bearish thesis and think that price really does still intend on going up. I need to see it close below it because price already broke below it. So if it broke below it and closed below it, I don't want to see it go back above and close above it. So that's it. So I explained to you then why the bias for the week is bearish. There's too much signals to keep in. The 1 week area is how there was no gap, fair value gap formed yet below this. But what compensates for that is how price moved beautifully into the CE, the wicks, and then came back down. One thing that could technically happen, but I see the chances of that as being very low considering what's already happened, is that price could aggressively go up and then take out the previous week high and the day high. But then, which could happen. I see that happen quite possibly, quite frankly, a lot when it comes to price, right? They trick you by having these, you see these long wicks within the fair value gaps, but then the very next candle becomes a wick that literally is practically the same size, if not bigger, than the wicking candle. So that happens. And if that were to happen, no sweat really, because it would still be underneath the weekly fair value gap. But then, so price definitely, I would definitely need to see price close below there. But now we're talking about more volatility with price, and then price taking its sweet old time before it eventually comes back down. So that could happen. I think it's less likely just because of how price really closed underneath that break of market structure fair value gap, which now may be a daily implied fair value gap, bearish fair value gap. But we shall see. Anything can happen. Overall, bearish for the week. So for the day, why am I telling you all of this? We already got our bias for the week. The next thing we want to see is how does price, more than likely, where do we believe price is going to for the week? So we know the bias, bearish. If price is going bearish, then where exactly is price possibly reaching for this week? Well, if I'm looking at this chart, all right, on the daily chart, and we use the daily charts to help us to determine that, right? If I'm looking at this daily chart, right, if we believe price is going down, then several places where price could be going, right? The biggest thing I want to take your attention to is right here and right here. If you look at the chart, let me scroll out some, and let me try going to the blink for real chart. All right, look at this. So this is the daily chart. We believe price is already going down, right? This was Friday's close. This is technically today's Sunday. Now the market's open, right? So price, if we believe price is going down, this is a wick candle, but it's not a long wick candle, so I'm not calling this an SLSL, right? Here is a long wick candle. Here is a long wick candle. And this is a real swing low point. See how price goes down and then up. And then here, this is a wicking candle too, but it's a singular wicking one as well. So here and here are basically the places where liquidity resides, right? So I'm going to go ahead and show you on the chart. I've got that liquidity at the bottom, which is 4242.25. And then I've got the liquidity right here, which is at 4235.5. That's the SSL is the sell side liquidity, which is your bearish liquidity, which is located here at 4235.5. All right. So basically, if you're paying attention, that's about a 100-point down move we're expecting price to get to. And when we say daily SSL, the daily SSL basically doesn't mean that we expect price to get there by the end of the day. No, it just means that we expect, usually when it comes to daily SSL, by the end of the week, before the week is over, price is going to reach this level. Price could easily go more than that level. All right, that doesn't concern us. We don't have no idea where price is actually going to close. What we do want to be more concerned with is where price is reaching for. So I have a feeling that, not a feeling, based on everything I said, if we know that price is going down, we know last week it took out the BSL, right? Then the daily BSL, buy side liquidity, the bullish liquidity. So then, and then it swung low. Well, not to say last week, but previous weeks it took it out and then it swung lower. Now we have cause to believe that it's going to take out the sell side liquidity and the bearish liquidity, so daily SSL. And where is that? So that's these two levels here, the 42.25 and the 4235.5. So more than 100 points down. All right. So now, what does this mean? That's where we believe price is going to ultimately be for the week. So now what I want to find out is, well, can we determine based on the charts, what does it hold tomorrow/today for Sunday market open? Well, like I said, the big clue right here is this candle. The fact that price closed, at first, when I first looked at charts, I was thinking, dang, price is just undecided, right? Because look at the weekly chart. The weekly chart, price wigged down. Look at the monthly chart. Monthly chart, Price formed a doji. It's in the middle of a doji right now. It's in the middle, not formed. It's in the middle of a doji because this is literally the middle of the month, right? And it's a doji. And then look at the quarterly chart. Another doji, right? So at first I was thinking, dang, price is really undecided, right? But now look at going back to this daily chart. The way when I really sat back and started to pay attention to the little details and the signatures that price is really showing me and the algorithms are really showing me in this chart, it really makes me believe bearish. The biggest thing is yesterday's close, Friday's close. So once again, look at how price wicked off of the bottom of the weekly fair value gap, as well as the daily fair value gap. So the daily bearish fair value gap is in here, and it also wicked off the weekly fair value gap, right? And the day before that, it basically went only to the CE. So boom, it went up into it, but closed below it, right? And closed aggressively below it. See how the wick, this is the open, this is the high, and then it went this low and then closed here. So that was a very aggressive move down. And not only that, like I said, the way that it closed below here. All right, closed below that that daily break of market structure fair value gap, which is one of the toughest fair value gaps to just go through, right? Price usually tends to be well supported in those kind of fair value gaps. So if it's a break of market structure fair value gap, a bullish one, then price should have stayed up, but it went down and closed below it. So this is why I'm such a stickler. I really want to pay attention to how price moves today. I seriously doubt that it's going to close above that CE. But if price, that doesn't mean that price can't wick, all right? Wick up there, but I want to see that it closes below it, because if it made the signature on Friday to purposely close below it, then that means then it's in 9 times out of 10 should be acting as an inversion fair value gap. And if it's an inversion fair value gap, then that should be something, because especially considering that it was a break of market structure one, it should be something to keep price down. So that's what I want to see. If my bearish thesis for this week is truly going to play out. No ifs, ands, or buts about it. But price can actually wick anywhere here down. So that's that. Let me see if there's anything else I want to tell you guys about that. All right. So we don't want to see price close anywhere above 4362.37 tomorrow. That's the CE of the daily break of market structure fair value gap, which should be acting as an inversion fair value gap if price is going to be bearish. But price, I can see price going as high as the 1/4 weekly wick, 4371.25. So if you're in longs, my recommendation, you better get out anywhere above that anywhere above that what is it, the CE of the daily fair value gap. It possibly can go as high as 4391, but then it's going to have to make a long way down. It could possibly go to the bottom of the fair value gap, just touch it and come back down, which would be a great signature, but it's going to have to make a long way down. So if that's the case, then that's going to be very volatile. Now, one thing I wrote, what did I say? I said a big clue will be how price tomorrow opens and what liquidity takes out first. Well, technically, I wrote this like 11 something this morning. That's when I finished all of my analysis for the week. I'm just doing the videos now, as this is when I had time to sit down and do it. But what I said is that a big clue will be how price opens. Tomorrow opens, which is today. As today's market and tomorrow tends to be counted as one day, and what liquidity it takes out first. If price goes down first, then price intends on closing up. Then price intends on closing up, then and actually better keeping the story intact for how price to wick off the weekly low levels, or CE, CE of daily plus fair value gap, which we anticipate will act as an inversion fair value gap. And then price can stay true to price, rarely closing down down big 3 days in a row, while also setting price up beautifully to aggressively head to 4291.5, and then eventually go to take out the daily SSL. Okay, so basically what I said here was that basically you see what's happening here. Price price went down pretty big 2 days in a row. This is a pretty big move down, even though it wicked up some. This is definitely a big move down, right? So it's very rare that price goes down 3 big days in a row, right? And so with that in mind, maybe they don't consider this big. I don't know. I think it's pretty big. This is pretty big. All right. And so with this in mind, what I was saying is that I actually like the idea of price going up first, because if it goes up first, then that sets a nice story for price to go aggressively down. So with that in mind, I don't know. I don't know what I said here. So the point is, we'll see what it is. I already told you. Now, here's the next key. Because I'm a day trader, I tend to, well, I do all kinds of investing. But right now, I'm focusing primarily on day trading. I'm getting in and out of the markets on the same day, especially with all of the volatility in the markets lately, and for other personal reasons. But nonetheless, the biggest thing I want to say is that the hourly also is the chart then that day traders will tend to use to help them determine what price is more than likely going to do. This is something I don't like. Look at this. So price closed on the hourly chart above the CE. All right. But here is an example where it did that too. But this wasn't an inversion fair value gap yet. But here it did that too, closed above it, but then the next one went lower. So we'll see how this next candle plays out. Definitely, I don't want to see it closing above it for the day. But right here, the first hour is already done. The 6 to 7 hour, 6 p.m. to 7 p.m. hour is already done. And you see price already closed above this. And it took out the 1 hour. Look at this. It took out the 1/4 CE wick, and it took out it took out the 1/4 1 hour wick, and it took out the CE 1 hour wick. So if that's the case, then price may take out the BSL first. And so that is definitely okay. That's why I put it up here. And in fact, this is something like what we want to see. Price, if we expect price to go up, we expect to take out some form of BSL, buy side liquidity first before, or short-term high first before it goes down. Well, not to say short term. If we're talking about truly down, where we wanted to go, we wanted to take out a higher time frame. So a 1 hour level is a good time frame before price reverses. A daily level is a good level is a perfect level before time reverses. But yeah, so price can go up here. But like I said, if I want to see that if price goes up here, then price doesn't close up above here. This is already a bad sign. I just wanted to see price run aggressively into it and then come down. That's really what I wanted to see. But the fact that it's taking a sweet little time, this makes me a little more reluctant. So we'll just watch and see what happens. Nonetheless, what I was saying is with the hourly, what I'm expecting to happen what I was anticipating happen. So it looks like I'm already wrong for this. What I was anticipating is I said because price closed, you see how this candle, it closed below the CE of the 1 hour wick. So it closed below it. The CE was 4351.87. It closed at 4351.5. All right, so that's literally, that's a bona fide close below, because it could have been 7.5, but it chose to be at 0.5. It closed below it, so to me that was indicative that price intended to go down, right? So what I was expecting was price taking out the 1 hour SSL first and then going up, right? And hitting the eventually, if it, the more low it went, so 4345 or 4340, then that would give more fuel for it to just going up here and stopping at the CE. That's what I was anticipating happen. The fact is, price closed above here, and so it looks like more than likely it's going to take out the 1 hour BSL first. If it takes out the BSL, that is fine, but then now price has to go aggressively down. So let me just read what I said. Price closed below the CE of the 1 hour wick. Again, this is further fuel to make me believe that price will go down to take out the previous day low. But it may in fact go to take out the 1 hour SSL. So this was the previous, let's find out what the previous day low is. 1 year, 1 day, the previous day low is, oh, I didn't even write that. Previous day low, I'm gonna write this in my chart, is here, low is 4340.75. So let me go ahead and write that, 4340.75. Prev day low. Okay, previous day low and 1 hour SSL. So I said that price closed below the CE of, going back to the hourly, it closed below the CE of the 1 hour wick. Again, this is further fuel to make me believe that price will go down to take out the previous day low, right? But it may in fact just go to take out the 1 hour SSL, which is right here, 4345.75, and then make its way out to take out 1/4 of the 1 hour wick at 4360, which it did, but it actually took out the CE, which is slightly above the CE daily break of market structure fair value gap at 4362.37. So I anticipate that if price goes up there, it will still close below. Price may also go out to take out the 1 hour BSL at 4367.25. But I still think price is less likely to do that, as price chose to side bearishly on Friday's closing hour, and even going up there would leave some room for some bullishness, at least in the very short term, which I guess isn't too bad. So this gives me my framework for tomorrow, 4362.37. It won't go above, price won't go above 4383.50 and would close below 4362.37. 0.75. We shall see. So basically, I said price is going down and then going up for tomorrow, and then more than likely closing up tomorrow. Well, so far. Not to say I'm wrong, but some things are a little off. So price clearly gapped up and it went up. It gapped up and it went up. Oh, crap. And what I missed was how price closed the gap. Look at that. Oh, no, it didn't. So price gapped up and it went up. Okay. No, this shit is going back down. All right. And so what I said will happen, guys. We'll see. We'll see. So here it broke. Here it went above. Created a swing high. Here created a sort of swing high. But here it created a high, but it didn't take out this high. So I'm thinking what's going to happen is that eventually, who knows, because this is a Sunday night market, which the market tends to move like snail's fucking pace during this time. Snail's pace during this time. I'm thinking price is going to eventually, like I said, it's not going to close above here. And I'm not talking about on the 1 minute, but it's not going to close. I did believe it wasn't even going to close above the CE on the hourly, but it just did. So definitely not on the day. So I believe that tomorrow when I wake up, we will not have seen price anywhere up here. But if it is, whatever, price will eventually come back down here. And I think we're starting to see the beginnings of this now. But point is price may still go up some. Take out that BSL. It looks like it may want to take out the BSL first. And that's actually not concerning because, like I said, usually before price wants to go one direction, it's going to take out the BSL in the opposite direction. So if price wants to go short, it may take out the BSL, the 1 hour BSL going up first. And then if price wants to go long, it will take out the 1 hour SSL first. So, still believe that price is going to go to close this gap sometime. So, how much more room it got to go up beats me. This would have been a nice room up. Anytime it came right out of here, that would have been great. When they take out the BSL, that would possibly be another great one. We'll see. That's it, really. Looking through the charts, seeing what I see. Price is going to come to fill in this gap. Boom. And then eventually take out this 1 hour SSL. That's my story and I'm sticking to it. Well, I don't know how price is going to close tomorrow. I just know it's behind better close below 4362.37. That is my story. I'm sticking to that. We'll see what happens. That's it for the charts. Let me know your thanks and your thoughts and your comments. Take care.